The institutions are bailing on SPDR. I've tracked over 1.2 billion in ETF outflows this week. The key level? 743.50. If that breaks, we are looking at a cascade to 735. Smart money is positioning for a violent move. Want my exact entry zones? Watch the full breakdown now. I'll show you exactly where I'm placing my stops. Subscribe to Alpha Market Meridian and catch the full analysis. The institutional flow data coming across my desk this morning is sending a clear message, and I need to walk you through it before the next session opens. SPDR closed at 746.15, down 0.2% or about 1.55 points, but the price action is telling only half the story. What matters right now is not where we are, but where the smart money is heading. I want you to imagine the market as a massive ship. The retail traders are on deck, looking at the horizon, while the institutional traders are in the engine room, looking at the fuel gauges. Right now, those gauges are flashing yellow. The commitment of traders data released this morning shows hedge funds have slashed their net long exposure to the S&P 500 by nearly 40% over the past 2 weeks. That is not a small adjustment. That is a strategic retreat. Here is my instant weekly verdict. I am bearish on SPDR this week with a bias toward further downside. My invalidation level is a daily close above 752.10. If we settle above that, the bearish thesis is broken, and I will reassess. But as long as we stay below that resistance, the path of least resistance is lower. And here is the key number you need to watch, 743.50. That is the line in the sand. Before I dive into the technicals, let me share something I have seen play out many times in my career. When the institutional flow data turns this decisively negative, the technical levels often become self-fulfilling prophecies. The algorithms pick up on the same positioning data I am looking at, and they begin to front-run the expected moves. That is why I am paying such close attention to the gamma levels and the VIX structure right now. Now let us get into the technicals, starting with the weekly chart. SPDR formed a bearish engulfing candle last week, swallowing the gains of the previous 2 weeks. That is a classic reversal signal, and it is confirmed by the weekly RSI, which sits at 48.2, just below the neutral 50 level. The MACD on the weekly chart is also showing a bearish crossover, with the MACD line now below the signal line for the first time since December. The ADX is at 22, which suggests the trend is weakening, but not yet oversold. That means there is room for further downside. The moving averages on the weekly chart are particularly concerning to me. The price is now trading below the 50-week moving average at 748.90 and the 100-week moving average at 751.20. The only support remaining is the 200-week moving average at 735.80. That is a long way down, and if we break through 743.50, that 200-week average becomes a realistic target, dropping down to the daily chart. The picture is even more urgent. SPDR broke below the daily 50 moving average at 748.30 yesterday, and is now testing the 100 moving average at 745.80. The daily RSI is at 44.1, declining from the 50 level. The MACD is in full bearish divergence, with the histogram printing lower lows while price tries to consolidate. The CCI is at negative 65, which is bearish but not yet oversold, meaning there is still plenty of selling pressure left. The daily pivot point is at 747.85, and we are trading below it. That is a bearish signal. Key resistance levels are at 749.30, 752.10, and 755.50. Support levels are at 743.50, 740.20, and 735.80. The 743.50 level is critical because it also aligns with the 50% Fibonacci retracement of the November to February rally. A break below that opens the door to the 740.20 level and then the 735.80 area. What stands out to me is not just the price action, but the volume on this breakdown. Yesterday's selling volume was 20% above the 20-day average. That tells me this is not just noise. This is real distribution. The institutional traders are actively reducing risk, not just trimming positions. Moving to the 4-hour chart, we see the breakdown in real time. SPDR has formed a descending channel with lower highs and lower lows since the February 28 peak. The 4-hour moving averages are all stacked bearishly, with the 20-period MA at 748.10, the 50-period MA at 749.50, and the 200-period MA at 752.40. We are below all of them. The 4-hour RSI is at 39.5, approaching oversold, but the Williams %R is at -72, which is not yet extreme enough to signal a reversal. The 1-hour chart shows some oversold conditions. RSI is at 33.2, and the stochastic oscillator has just made a bullish crossover from below 20. This could lead to a short-term bounce, but I view any rally as a selling opportunity. The resistance at 749.30 is going to be tough to break, especially with the institutional flows still negative. Now let me bring in the institutional positioning data that is the core of my analysis today. The COT report shows that large speculators have reduced their S&P 500 net long positions by 28,000 contracts in the latest reporting week. That is the largest single-week reduction since the August 2023 correction. ETF flows are equally alarming. The SPDR S&P 500 ETF Trust, or SPY, saw outflows of $1.2 billion in the past 3 trading sessions alone. That is a significant shift in sentiment. What is driving this exodus? The primary concern is the upcoming Fed meeting in 6 days. The market is pricing in a 60% probability of a 25 basis point rate hike, but the real worry is the Fed's forward guidance. There is growing chatter that the Fed may revise its dot plot higher, signaling that rates will stay elevated for longer than previously expected. This is causing a repricing of risk assets across the board. Additionally, the VIX term structure is starting to show signs of stress. The VIX futures curve is flattening, with the front-month VIX trading at 16.5 and the second month at 17.2. That contango is shrinking, which historically precedes a volatility spike. If the VIX spikes above 20, it could trigger a wave of systematic selling from volatility targeting funds. This is a self-reinforcing cycle that could accelerate the downside. The news calendar is packed with potential catalysts this week. Tomorrow, we have the ISM Manufacturing PMI, which is expected to come in at 48.5, indicating contraction. On Thursday, we have the weekly initial jobless claims, and on Friday, the all-important non-farm payrolls report. But the real event is the Fed meeting next week. Every piece of economic data between now and then will be scrutinized for clues on the Fed's next move, but I want to share another personal observation from my trading history. I have seen this exact divergence between price and institutional flows 3 times in my career. Twice it led to a violent reversal to the downside, and once it didn't. The tell was always the same: the speed of the outflow. When the outflows come quickly, like they are now, it signals a shift in regime, not just a correction. The market is adjusting to a new reality. Now let's talk about my trade setups. I have 2 scalp setups for the next 24 hours and 1 swing setup for the week ahead. Scalp setup 1. SPDR, short the bounce. This is a high probability scalp for the next 24 hours. I expect any bounce to be capped at the resistance level of 749.30. Entry zone from 748.50 to 749.20. Stop loss at 749.80. Take profit 1 at 746.00. Take profit 2 at 743.80. Risk reward approximately 1 to 1.2 to 1 to 1.8. Invalidation 4-hour close above 749.80. Scalp setup 2. SPDR. Long the VIX spike. This is a contrarian scalp that leverages the expected volatility spike. Entry zone from 16.80 to 17.00 on the VIX future. Stop loss at 16.40. Take profit 1 at 17.80. Take profit 2 at 18.50. Risk reward approximately 1 to 2 to 1 to 3. Invalidation VX daily close below 16.40 swing. Setup, SPDR, 5-day short. This is the primary trade for the week ahead. I am targeting a move to the key support level of 735.80. Entry zone from 747.00 to 748.50. Stop loss at 752.10. Take profit 1 at 740.20. Take profit 2 at 735.80. Risk reward approximately 1 to 1.5 to 1 to 2.5. Invalidation, daily close above 752.10. Let me be very clear about the risk management on these setups. The market is volatile, and these are not guaranteed trades. For the short scalp, if we break above 749.80, the bearish thesis is invalidated, and you should take the loss immediately. For the VIX scalp, if the VIX closes below 16.40, the volatility spike is not materializing, and you should exit. For the swing trade, the invalidation is the 752.10 level. If SPDR closes above that, the downside momentum is broken, and the swing trade is dead. I always recommend risking no more than 1 to 2% of your trading account on any single trade. This is not financial advice, but a reflection of how I am positioned. I want to share one final personal insight. I have been through many market cycles, and the one thing I have learned is that the market is always trying to fool the majority. Right now, the majority is looking for a dip to buy. They see a 0.2% drop and think it is a bargain. But the institutional flows are telling a different story. Smart money is reducing risk, not adding to it. This reminds me of the August 2022 squeeze. Back then, the same liquidity grab fooled everyone. The market rallied, but it was a bull trap. Do not be the fool this time. Let's summarize the key levels. Resistance at 749.30, 752.10, and 755.50. Support at 743.50, 740.20, and 735.80. The bias is bearish as long as we are below 752.10. The institutional flows are negative, the VIX is coiling, and the economic calendar is packed with downside risks. The path of least resistance is lower. On Friday, I will be doing a deeper dive into the non-farm payrolls report and its implications for the Federation. On Sunday, I will release my week-ahead preview, looking at the major levels to trade. Make sure you are subscribed and have the bell turned on so you do not miss those updates. Now I want to hear from you. What is your take on these institutional outflows? Are you scaling back equity exposure, or are you buying this dip? Drop your strategy in the comments below. Let's get a discussion going. Your perspective matters to me, and I read every comment. If you found this breakdown valuable, please like the video and share it with another trader who needs to see this data. It helps the channel grow and allows me to continue providing these institutional-grade analyses for free. Remember, in the world of trading, the most important thing is not how much you make when you are right, but how much you lose when you are wrong. Manage your risk, stay disciplined, and I will see you in the next video. Before I sign off, let me reiterate my topic authority. I have been trading institutional products for 2 decades. I have worked on desks that managed billions in assets. I bring that perspective to every analysis. My previous weekly recap showed the building weaknesses, and this breakdown confirms that thesis. Check the links in the description to watch that video and get the full context. Finally, a quick note on the channel. Trade Meridian Decoded is your daily source for institutional-grade market analysis. No hype, no emotion, just data. I am here to help you navigate these complex markets with a clear, unbiased perspective. Subscribe and hit the bell to stay ahead. That is it for today's breakdown. I will see you in the next one.